We're told a Rolex is the ultimate safe haven investment, a tangible asset that defies market gravity. This perception reached a fever pitch after the pandemic when prices for models like the Daytona and the green-bezeled Submariner tripled, cementing the idea of Rolex as the ultimate safe harbor. But what goes up in a speculative frenzy must contend with reality. For 9 consecutive quarters, the secondary market has endured a stark and prolonged correction. Some have dubbed it the Great Rolex Recession. Prices for top models from Rolex Patek and Audemars Piguet have plummeted by as much as 30 to 40% from their 2022 peaks. This has created a critical question. How can an asset be a safe harbor and simultaneously be subject to a market collapse of this magnitude? This report will dissect the ugly truth behind Rolex prices in a recession. The truth is not that a Rolex loses its quality, but that the speculative, hype-driven market premium, where the real financial risk lies, can and does evaporate when economic fear replaces the fear of missing out. If you appreciate analysis that cuts through the hype, subscribe, like, and hit the notification bell. Let's get into it. This isn't just a random dip. The post-COVID bubble has definitively burst. Central banks raised interest rates, crypto markets crashed, and the speculative capital that fueled the boom has vanished. Everyone who bought at the peak is learning a very expensive lesson. And this analysis is not financial advice. It's a breakdown of the market mechanics that led to this point. To understand why prices collapse, you first have to understand that the Rolex market is a two-tiered system, and it is intentionally rigged against you. It's not a conventional retail environment. It's an ecosystem meticulously engineered to create a fundamental disconnect between the official retail price and the watch's true market value. At the heart of this is Rolex's corporate strategy of manufactured scarcity. Despite having the capacity to produce an estimated 1 million watches a year, the demand for its popular models dramatically outpaces availability. This is not a failure of production. It is a calculated core tenet of the brand's business model. By tightly controlling supply, Rolex prevents brand dilution and creates a powerful aura of exclusivity. This disciplined approach was clear in 2024 when the company was reported to have slightly cut production to align with a cooling global market, the first time it had done so since the 2008 financial crisis. This strategy transforms buying a watch from a simple transaction into a lengthy, frustrating pursuit. The harder a Rolex is to get, the more coveted it becomes. This brings us to the gatekeepers. The authorized dealers, or ADS, operate under the severe constraints of this scarcity strategy. They receive limited, unpredictable allocations of the most sought-after stainless steel models, like the Submariner, Daytona, and GMT Master. These watches often arrive in single-digit quantities and never even reach the display cases. This imbalance has forced ADS to abandon traditional first-come, first-served waiting lists. Instead, they use an opaque, discretionary system called an interest list. Allocation from this list is not based on time. It is based on the strength of your relationship with the dealer. And that relationship is almost exclusively defined by a significant prior purchase history. This typically involves less desirable, higher-margin products like gold and diamond jewelry, or watches from other, less popular brands the dealer also carries. This practice, often called bundling, creates a massive financial barrier. To be offered the opportunity to buy a steel Rolex at its retail price, a customer must often first spend an equivalent or greater sum on other goods. You are effectively paying a premium in a different form, and this is reinforced by the exhibition-only models you see in showrooms. Those are real watches, but they are not for sale. They serve to tempt but not to sell, reinforcing the message of unavailability and fueling consumer frustration. The direct and inevitable consequence of this system is the robust secondary, or grey market. The grey market is not an illicit or black market. It is the free market's natural response to the artificial supply constraints of the official channel. Crucially, it functions as the true and transparent barometer of what a Rolex watch is worth at any given moment. Grey market dealers get their inventory from flippers, VIP clients with a strong AD relationship, who are allocated a hot watch at retail and immediately sell it for a substantial risk-free profit. An open secret is that a robust pipeline also exists between some authorized dealers and grey dealers, suggesting some ADS are capitalizing on the very premiums their own practices create. The price on the grey market is therefore two parts: the watch's official retail price and a market-driven premium. This premium is simply the monetized value of immediate gratification, the cost to bypass the AD's multi-year games. It is this premium, a figure born of pure market sentiment, that is the most volatile component of a Rolex's value and the epicenter of your financial risk. The entire system is designed to invert risk. In a normal market, the manufacturer and retailer bear the risk of unsold inventory. In the Rolex world, this risk is transferred entirely to the end consumer on the grey market. The AD sells 100% of its desirable inventory instantly, bearing zero risk. The consumer who pays a premium on the grey market bears 100% of the risk that this premium will disappear in a downturn. The system is perfectly insulated to protect the brand and its partners, leaving the individual owner to act as the ultimate financial shock absorber. So how does this system hold up in a real recession? The safe haven thesis falls apart when you look at history. Let's start with the early 1990s recession. This was a pre-hype world before watches were seen as a mainstream asset class. The S&P 500 stock index experienced a significant decline of nearly 20%. In this environment, Rolex behaved like any other luxury good. There were no massive premiums. On the contrary, the private market softened considerably. As people needed to raise funds, they sold their luxury goods, creating a buyer's market where discounts on used models were the norm. The 2001 dot-com bust was different. The S&P 500 suffered a devastating decline of over 49%. This crash was unique because it was the collapse of intangible tech stocks. As vast sums of paper wealth were wiped out, there was a notable shift. High net worth individuals, reluctant to invest in collapsed markets, channeled their liquidity into valuable horological items. These tangible assets were sought for their perceived stability. This was the very beginning of the watch as an asset narrative. But the 2008 global financial crisis was the ultimate stress test. This was a deep, systemic crisis. The S&P 500 collapsed by a staggering 56%. In stark contrast, gold, a true safe haven asset, fulfilled its traditional role. Its value increased by 25% as investors fled to safety. The Rolex market's performance reveals the disconnect. On paper, Rolex appeared immune. The company did not decrease its retail prices. In fact, historical price charts show a steady, uninterrupted increase in retail prices right through the crisis. In 2008, the retail price for a Submariner date was $6,000. This created a powerful but misleading narrative of stability. The market reality was a bloodbath. The broader luxury watch industry was hit hard. The Richemont Group, parent to Cartier, reported it was facing the toughest market conditions in its 20-year history. Grey market dealers recounted that in 2008, the wheels stopped, and business effectively paused as fear paralyzed the market. Most tellingly, after years of scarcity, authorized dealers suddenly had inventory. Forum discussions from the period confirm ADS were actively calling customers to offer them watches, a scenario unimaginable just a year prior. Liquidity evaporated. It was a fantastic time to be a buyer with cash, but a disastrous time to be a forced seller. This brings us to the 2020 COVID whiplash. This was an anomaly, the shortest recession in history, followed by an unprecedented global wave of government stimulus, near-zero interest rates, and a boom in speculative activity, from crypto to meme stocks. This created a perfect storm for a speculative bubble. The boom from 2020 to 2022 was pure mania. With travel shut down, consumers, many flush with stimulus cash, pivoted their spending to tangible luxury goods. This was amplified by a new generation of younger, crypto-rich buyers who explicitly viewed watches as investment vehicles to be flipped for profit. Secondary market prices detach completely from reality, with some watches trading at 3 to 4 times their retail price by the peak in early 2022. The bust from 2022 to the present was just as dramatic. The bubble burst as the economic environment reversed. Central banks raised interest rates, the crypto market crashed, and the speculative capital vanished. The market was suddenly flooded with inventory as speculators and over-leveraged dealers rushed to sell. The watch chart's overall market index has fallen by more than 32% from its peak, wiping out years of gains for those who bought at the top. History shows that when the economy truly breaks, the Rolex secondary market breaks with it. The 2020 event wasn't a new normal, it was a once-in-a-generation bubble that is now violently recalibrating. This leads us to the ugly truths of investing in a Rolex during a downturn. Truth number 1, you are not investing in a watch. You are gambling on the premium. The single most critical truth is that your financial risk does not come from Rolex lowering its retail price. That has never happened and is exceedingly unlikely. The entire risk is concentrated in the collapse of the secondary market premium. A buyer paying $32,000 on the grey market for a new steel Daytona, which has a retail price of approximately $16,000, is not making a simple purchase. They are effectively buying a $16,000 watch and simultaneously placing a $16,000 speculative bet that market sentiment will remain high. That premium is not backed by steel, gold, or craftsmanship. It is backed by pure, unadulterated hype. The post-COVID correction is a painful illustration. Individuals who purchased a Daytona at the speculative peak for as much as $50,000 saw the market value of their investment plummet by 36% in just over a year. That catastrophic loss had nothing to do with the quality of the watch. It was the direct result of the hype evaporating. Truth number 2. Hype is a fragile foundation, and modern demand is built on it. The nature of the Rolex buyer has fundamentally changed. A significant portion of modern demand is driven by a new demographic. Younger consumers, often enriched by booms in tech or cryptocurrency, who view watches through the lens of financial speculation. This new foundation of demand is inherently fragile. It is not rooted in an appreciation for the brand's heritage. It is rooted in the expectation of rapid financial returns. Consequently, this demand is highly correlated with the health of other speculative assets. The 2022 watch market crash coincided perfectly with the crypto winter. When that speculative capital dries up, this entire segment of demand can vanish almost overnight. Truth number 3, liquidity is a fair-weather friend. In a booming economy, a popular Rolex is one of the most liquid luxury assets you can own. A sale can be concluded in hours. In a severe recession, this dynamic inverts with dangerous speed. The market becomes ensnared in a classic liquidity trap. First, supply increases. As a recession deepens and job losses mount, the number of forced sellers needing to liquidate assets to raise cash increases. Second, demand decreases. Simultaneously, the pool of potential buyers with tens of thousands of dollars in disposable income to spend on a watch shrinks dramatically. This creates a perfect storm of rising supply and falling demand. Grey market dealers facing their own financial pressures will drastically lower their purchase offers or stop buying certain models altogether. The asset that was once easily convertible to cash becomes illiquid precisely at the moment the owner needs the money most. The promise of liquidity only holds true when you don't desperately need it. Truth number 4, a Rolex is not a currency, it's a Veblen good. A common narrative is to equate owning a Rolex with owning gold, a tangible hedge against turmoil. This comparison is fundamentally flawed and dangerously misleading. Gold is a true counter-cyclical, safe haven asset. Its value is often driven by fear. During a crisis, capital flows into gold, pushing its price up, as we saw in 2008. A Rolex, by contrast, is a quintessential Veblen good. This is a luxury item for which demand increases as the price increases. This is because its value is derived from its exclusivity and its function as a public signal of wealth and status. This paradox works powerfully in a bull market, but it unravels in a recession. A Rolex thrives on economic confidence, prosperity, and a culture of aspirational spending. Gold thrives on fear and uncertainty. To confuse the two is to misunderstand the fundamental drivers of their value. So let's be clear, the Rolex market is a two-tiered system engineered to transfer all financial risk from the brand and the dealer directly to you, the grey market buyer. The recession-proof narrative is a dangerous myth proven false in 2008 and supercharged by the unrepeatable 2020 stimulus bubble. And finally, you are not buying a safe asset like gold. You are buying a status symbol that thrives on economic confidence, and you are placing a bet on a speculative premium that can and does vanish. The evidence is unequivocal. Buy a Rolex for its craftsmanship, its history, its aesthetic appeal, and the personal satisfaction it provides. If, over the long arc of ownership, it appreciates in value, that should be regarded as a welcome bonus, not a guaranteed outcome. To buy a modern Rolex at a significant premium, expecting it to shield you from a recession, is to ignore the clear lessons of history. In an economic storm, the crown offers no shelter. So I want to know your take. Based on this, is the grey market premium just a hype tax for skipping the line, or is it a sign of a permanently broken and manipulated system? Let me know in the comments.